We invested about 20 million and
Okay.
that position is worth about 100 million today.
5x in 4 years.
You know, the biggest mistake that investors make is they end up.
So what is the biggest loss of your life now?
I have seen losses running into a few $1 million.
So around 15-20 crores loss.
If you treat investing like a part-time hobby with part-time resources, it will pay you like a hobby. And the reality is hobbies don't pay, they only cost you money. The key to making money in investing and trading is
How much percentage of the companies that you've invested in gives you like 80% of your profits?
5% of my investments will probably generate 90% of the return.
Can you share an example of what is the most amount of money you made in a single trade?
I think the largest, I probably would have made about 80 to 100 million
In one trade?
in one trade. Yeah, we invested about 20 million, and
Okay.
that position is worth about 100 million today.
5x in 4 years.
So yeah,
You mentioned that this is currently $100 million worth for you. So that's like half of your family office portfolio?
yeah,
Oh, half of it is in just one company.
yeah. We
So
take concentrated.
You're extremely bullish on this.
So see what ends up happening is that Sharan, the way you, with the way portfolio, even if I've taken 5, 10, 15, 20 million bets over the years, what ends up happening is that some positions or some stocks will typically end up generating a lot more return, and by default that return will result in them becoming a larger part of your
Right.
portfolio. The biggest mistake that investors make is they end up cutting winners.
They're like, after I get 20% profit, let me leave.
Yeah. So let's say if this was a 20 million position when it began,
Huh.
so it didn't start out as a 20 million position. It started out as a 10 million position. Then we added on and so on and so on. But the point is that the way normal investors think is, I've invested, let's say 10 lakh rupees in a particular stock. It's become 12. Let me get out.
Right. That's how, yeah.
Yeah, and so you never let your winners really run. And what we found is that when you're running a personal portfolio, you have the flexibility to take large concentrated bets. You look at Mr. Buffett today, almost half of the public market portfolio is Apple. It's not that he's bought Apple. Apple started out as a small position.
It has now become half of his
It has
portfolio.
become now half of Berkshire's public market portfolio.
Well, why doesn't, like, once it becomes half of your portfolio, then don't you think that now we should start selling it? Or like, won't there be a concentration risk?
So again, I'll give you Rakesh ji's example in this. For Rakesh ji, Titan started as a very small position.
Correct.
It went up to 65% of his portfolio.
Huh.
He's been on record many times and he said every time it went to 60-65% of his portfolio, his team would say and come and say, sir, let's cut a little bit.
Huh.
He would cut from 65 to 50. It would go back to 65.
So it was a bad decision to cut it.
So it was a bad decision. So point is that, see, when you're right, and till the time that your core investment thesis doesn't change, or till the time you don't find another better opportunity, there is no point of really going out, cutting your winner, trying to meddle in, do the different things. Diversification at best is going to protect your portfolio.
So that's the second question I wanted to ask you, that you're somebody who believes in having a small list of companies which you really, really believe in, rather than just diversifying across hundreds of companies. Like, how many different companies does your public portfolio have?
The number of stocks actually doesn't matter. What matters is how much you hold in your top 5.
Got it.
How much do you hold in your top 5? Or your top 10 positions. That's really the that will decide if you're concentrated or diversified.
So is it like the 80-20 rule? Like, how much percentage of the companies that you've invested in like gives you like 80% of your profits?
My sense is it will be 590.
590
5% of my
picks.
investments will probably generate 90% of the return.
Wow.
Yeah, and that's not true for me. That's true for practically every large investor that you see. And that's true for the index as well.
Right.
You'll be surprised if you look at the Nifty from 1994, from 1,000 to we are at 20,000 on the Nifty roughly today. Majority of the gains of the Nifty, almost 60% of the gains of the Nifty have come from 3 stocks. So Reliance, Infosys and HDFC typically have contributed to 60% of the entire move of the Nifty. So think about this way, it's a 50 stock portfolio, but 3 businesses have really
moved the needle.
So this is true for most cases, and I think all successful investors really would see that this characteristic as a part of their portfolio.
When did you start?
So I started when I was 14, I think in 2003-4.
At the age of 14?
Yeah, at the age of 14 is when I started investing. And it's been a rewarding 20 years.
Got it. So what is your rank at CA?
I was ranked 9, All India rank 9.
Rank 9?
Yeah.
Okay. So when did you realize that your intelligence is at a much higher level compared to normal people?
First of all, I would not put it that way that my intelligence is higher. But I think, when I was ending school or towards the last few years of school, I realized that I had a gift from God in terms of being able to grasp things better, being able to learn things better, being able to remember things better.
So you were like a first rank in your school, all the classes?
Yeah.
Okay.
So I think that sort of helped me realize that obviously there are certain skills that I have been endowed with, which have helped me, and that's pure luck, I think.
But that usually ends up in people having a lot of ego. So growing up, did you have ego?
I think if I would not have seen probably those losses early on in my life, I would have had that ego. But I think the markets and losing money early on sort of humbles you very early. So see, think about it this way. If you're a 14-year-old kid, you're losing 50 grand. Then if you're a 17, 18-year-old kid, you're losing 15 lakhs.
Yeah.
Most people have not seen that kind of money in your entire life.
Yeah.
And for you to lose that kind of money, that is a rude wake-up call.
So you grew that 50,000 to 15 lakhs and then lost it all.
Yeah, then lost it all.
Let us say most of our audience, they are starting at the age of 24, 25 investing. And they don't really consider their parents' money as their money, because, we want to feel like, we did it all. So let us assume that we are starting from zero. We don't have our house, nothing. So if that is the mindset and I want to, let's say 25, 45, I want to hit my retirement goal, how would you invest your money?
So if for a 25-year-old who's starting out, assuming that they have a stable job, assuming that they have a fairly stable income source to be able to run their expenses and run their homes, then whatever I end up saving, I would have a very aggressive portfolio.
Okay. Can you define what is aggressive portfolio?
At age of 25, I would say I would be invested in equities by and large to the tune of 80 to 100%.
80 to 100%.
Yeah, 80 to 100%. Now, whether I would allocate that to predominantly large caps or predominantly mid caps or small caps will depend on the state of the market. But my sense is, at 25, you have the risk-taking ability. Even if things go wrong, you have time on your side, and time heals everything. We saw a 67% drawdown in 2008. But the markets came back up in about 15, 16 months.
So in today's market, because you talked about large cap, mid cap, small cap, in today's market, where would you allocate most of your money within equity? Large cap, mid cap or small cap?
I think I would have a broadly diversified view. Again, if over the long term, I'd probably say a simple 50-20-20, 50-30-20 split is a decent amount.
50 in large cap,
50 large cap, 30 in mid caps,
20 in small cap.
Is a fairly decent split to have. I think that's at a strategic level, that's a decent allocation to have.
So can you walk us through that process in a high level? I don't want to go to full detail. High level, how do you pick your companies?
So the first step obviously is the selection process, right? So when you're selecting a stock, or a business, you look at the underlying business and you see, does this business have the potential to be able to compound at a 25-30%?
So that is your benchmark. That's
correct,
what you need.
Correct. Okay. At a 25-30% kind of a level. Then you try, and if you get that answer as yes, I think this business has the potential, then you do a deeper dive into figuring out.
Wait, before we go there are 6,000 listed companies.
Yeah.
So would you open the balance sheet and the company financials of all those 6,000 companies, or is there a quicker way of filtering the first process?
So I think, what happens is that now, obviously, we've been in the market for 20 years. over a period of 20 years, you've built a certain mental model, I would say. You've seen a large part of these companies. I would have, over the 20 years of my of being in the markets, I think I would have seen about 1,500, 2,000 companies personally, and understood by and large the kind of business that they are in, what works for them, what doesn't work for them.
So basically you're telling me you already gone through the financials and the history of 1,500 to 2,000 companies in India over the course of 20 years.
Yeah. When you look at something that is, you'll not find many businesses that have the potential to grow at 25-30%.
Okay.
So that pool, even if you start from a 1,500 kind of a listed, equity listed pool, that will probably shrink to a good 150, 200 kind of names. There will be at any given point of time only those many names that are decent quality businesses.
So the way to evaluate this is it by looking some certain financial ratios, or is it just by understanding what the business does and looking at it from a macro point of view?
So first is understanding the business. Ratios will come in a lot later.
Okay.
It's when you go deeper into the business, when you start and when you make a final decision of whether you want to buy, how much you want to buy. That's when you start looking at valuations, financial ratios, etc. Your start is that you keep your mind open and you keep looking for ideas. I think you have to understand that the markets are a fertile land, and you will keep getting an opportunity. You will keep getting ideas on a day-to-day basis, and you typically have to have a first level screening process in your mind, basis the mental models that you build. That okay.
Can you give an example of the mental model that's there in your mind while you're evaluating the stocks of the country?
So let's say for example, you read an article of a particular telecom company doing well, and that you see 5-6 telecom and associated businesses mentioned in a particular article, etc. By nature now, by construct, you have an understanding that there are 3 or 4 direct plays, a few indirect plays as far as the telecom place is concerned, and do you want to really look at that space? You know what the general characteristic of the business is as far as them being able to make money is concerned. Do you think there is an opportunity? So you build that mental model that penetration is already there. You already have a large number of subscribers who have moved on to 3G, 4G. You are not going to see dramatic market growth happening from current levels. Most of the market share shift has already happened. By having this mental construct, you've understood and you can deduce the fact that, okay, you need not necessarily find you may not find a 25-30% kind of an opportunity in this space. So then you sort of discard that and move on. That's how you analyze and look at things.
So now coming back to the biggest loss of your life, it was started off with 15 lakhs loss at the age of 17. Now that you're 32, right?
Yeah, 34.
Now, what has been the biggest loss?
I would like to call myself 28, but I keep joking with my wife that I'm 28, but yeah, I'm 34 in reality.
So what is the biggest loss of your life now?
I would say there have been lots of losses. It's not that.
Okay.
I have seen losses running into a few $1 million.
So around 15-20 crores loss.
Yeah, easily. And not just once, but several times.
Okay.
So it never so happens that you make money one side. In fact, I firmly believe that we'll probably be right only about half the times.
But even if you're right half the time, you'll still make a lot of money.
So the key is, I think the way I look at investing and trading both is how much do you make when you're right. So you should have a rough ballpark of what's your win rate going to be. And I think for most people, a 50% win rate is by far the best that they will have. It's beyond that, if you're at 60% win rate, then you're probably a king. But a 50% win rate is decent.
So like people like Warren Buffett, Rakesh Jhunjhunwala, what kind of win rate did they have?
Rakesh Jhunjhunwala used to say that he had on his trading portfolio, he had a win rate of 35%.
That's a trading portfolio?
Yeah. Even for his investment portfolio, I think.
35%?
Yeah, 35-40% will be the number of stocks which have truly generated most of the return. So win rate is just one part of the equation.
So when you mean win rate, it has made some sort of profit.
Yeah, it has made some sort of
And
profit.
for Rakesh Jhunjhunwala, it has only been 35% of his picks.
Correct.
Which have made profit. 65% made loss.
Correct.
But in the 35%, he made so much money that he became very rich.
Absolutely. So the key to making money in investing and trading is how much are you right when you are right,
Got it.
and how much are you wrong when you're wrong. You've got to make sure. So I think about it as a coin toss. Imagine if you were going to do a coin toss, you're going to be right 50% of the time. But every time you're right, if you make $2, and every time you're wrong, you lose 1 rupee. If you infinitely toss the coin,
You'll always make money.
you'll always make money.
Right.
The odds and the risk reward has to be in your favor. That is the key. I think that is the most important key. And today, every time I speak to a trader, every time I speak to an investor, I ask them, do you know what your win rate is? Do you know what your average profit is? Do you know what your average loss is? And I am surprised that 99.9% of traders don't know these stats. And which is why this was my personal insight. And when we were building SAMCO, we put this as a part of the product, that you need to have people know what's their average win, what's their average loss, what's their win rate, and that these three parts of the equation
Makes you a better trader.
will make you realize, will result in whether you are actually going to be a profitable trader or not. So for most people, the equation is you'll have an 80% win rate, because most people can't book losses. So they will hold a particular stock till the time it actually ends up becoming a winner. So they'll have a 80% win rate, but their average gain will be, let's say, 5%, and their average loss will be 25%.
Oh, so that is the problem. So that in the hope of increasing your win rate, meaning I want to make profit with every company that I invest in.
Correct.
You are sort of stifling the exponential growth that you could have made with a few of those stocks which you picked right.
Absolutely.
Which sort of makes you overall unprofitable, because your losses which you have made were very steep.
Correct.
So that is the problem.
So people are obsessed with having a high win rate. Individual traders and
I mean, that's how the human psyche is also. I have to make money in everything I invest in.
Correct.
We're not, comfortable with saying, like you said, Rakesh Jhunjhunwala himself had a 65% loss rate. Now, if I ask average retail investor, are you okay with losing money 65% of the times when you invest? Most people will say no.
No, absolutely.
And that mindset is the mistake when you go towards investing or trading.
And that's why retail investors end up compounding mistakes and not returns.
Yeah.
So when you buy something at $100, it doesn't go in favor, it becomes 90, you'll go on average. So you'll compound your mistake. Then it will become 80.
What do you mean you'll go on average? What do you mean?
So a lot of people, what do they do? Okay, I bought it at 100, now it's become 90, I bought 100 shares at 100. Let me buy 100 more shares at 90. My average price will reduce to 95. Then it will go back to 80. You will say, okay, let me buy another 200 shares. My average price will become 86, 87.
So what is the right thing to do when this happens?
So you actually should not average, you should not average your losers. You have to make sure you average up and not average down.
Okay.
It's a very counterintuitive thing.
Yeah, that's what.
But
most people say when it falls, you buy more.
Yeah.
But what is the logic here?
So the theory is that if, let's say, you bought something at 100 and price goes to 90, price goes to 80, the market is giving you an indication that you are wrong. You are wrong, and you should not compound your mistake by putting more money. This was a bad decision that you made. If the price goes from 100 to 120 to 130 to 140, the market is telling you that you are right.
So then actually add more money.
Correct.
Got it.
And on certain occasions, it may be when you are seeing a loss across the board, or you are seeing a drawdown or a bear market across the board where everything is falling, where you bought something at 100, the Nifty was 20,000, your stock fell to 80, the Nifty also fell by 20%, and everything was falling, so your stock also fell in pretty much in line. Then it's okay even if you end up averaging a little bit.
Got it.
But if you are going against the market, and if you think that something was 100 and the Nifty was 20,000, Nifty's become 22,000, but your stock has gone to 80.
Which means you were wrong.
You were wrong.
So just to summarize this, if your stock also falls, but the overall market is also falling, then it is like, okay, now you can average it down because the whole market is falling. So yours also is falling down. But if your stock is falling, but the overall market is increasing, it means you were wrong. So don't average your...
Don't compound your mistake.
Don't compound the mistakes. Got it. So just to go back to the loss, right? Because a very interesting concept, right? So I feel like the mindset of an investor is supremely important when it comes to investing. Now, when you are making those, 15, like we started off with a 14 lakh loss, 15 lakh loss when you were a kid, and now you are, on an average, you're comfortable. I don't know if you're comfortable, but $1 to $2 million loss you're making. But what is your mindset at that point of time? What do you tell yourself? Do you get a good night's sleep? Like, what happens to you that time?
No, so I'm extremely comfortable.
You don't care anymore. It's
a few $1 million. That's
few $1 million. You're fine.
Yeah, I'm fine. I mean,
okay.
I see. At the end of the day, the way I think about it is that if I make reasonable decisions over a period of time, and I don't make stupid mistakes like, let's say, averaging down, or if I just don't make stupid mistakes, I'll be fine. It's okay even if I lose a few $1 million here and there. But by and large, the markets will be kind enough to reward patience and to reward the courage of being in the market for a long period of time. And those mistakes will get corrected by all the right decisions that you make over a period of time. So,
makes sense.
I don't think you should...
But did that take you some time to develop this sort of mindset? Because I'm sure when you were 17, when you lost 15 lakhs, you didn't think like this.
Yeah. So the way I think about this is think about it this way. And this is how every investor or trader should think. See, we think very short term. So we think about every trade. The mindset that I have tried to build over a period of time is over my lifetime. Okay. I think if I'm going to be in the markets for, let's say, 30, 40, 50 years, I think I may make about 1,000 investments. But roughly here and there, I think 1,000 investments is what I'll make. Now, if I'm going to make 1,000 investments, what difference does it make if I go wrong in 5? Or what difference does it make if I go wrong in the next one? Think about this as a cricketer, right? I mean, you're going to play 1,000 balls or 30, 40,000 balls in your career. If you lose your wicket on one, it doesn't mean, I'm going to shut my career and go back.
Right.
You said, okay, this was a wicket, I lost my wicket. I'll learn whatever I can learn. But tomorrow is a new day. I will go tomorrow and I will try and do my best. And I think building that mindset that each trade or each investment that you make is just one amongst thousands of trades that you're going to make will help you deal with losses better.
So there's an interesting question that I have, that do you think a retail investor is better off investing by themselves by picking stocks or investing in mutual funds? Because I might think that, hey, the mutual fund has a mutual fund manager and 5-10 analysts working with him. They're all experts with CFA, CA degree. Who am I to be better than them? So what is your thoughts on this?
So my view is very clear. If you don't have the expertise, if you don't have the wherewithal to be able to think about investing and trading as a full-time job,
okay,
you should be giving your money to a fund manager.
Okay.
Or a wealth manager, whatever way you decide. For the simple reason that, again, I am a firm believer, if you treat investing like a business, it will pay you like a business. If you treat investing like a part-time hobby with part-time resources, it will pay you like a hobby. And the reality is, hobbies don't pay, they only cost you money.
Yeah.
Businesses pay you.
Then by that logic, most people cannot invest, no? Because we all also have to go to a 9-to-5 job, we have to work. And then 9-to-5 trading hours also is gone. So then what is the advice? You're saying most people who also have a 9-to-5 job cannot invest by themselves by picking the stocks?
So the way you should think about it is, see, I am no one to say whether you should invest or not.
Yeah.
But the way you should think about it is that take a benchmark. Okay, you take a benchmark, let's say Nifty 50 or take a Nifty 500 or whatever benchmark that you deem fit. And you benchmark, you can start with trading, investing, even with your 9-to-5 job, even with if you're running a full-time business, you can start. You compare your results to your benchmark over a 3-month, 6-month, 1-year period. Give yourself a certain amount of time. Give yourself a year or 2 years. That's fine. There's no problem in that. And see if you're doing this job yourself, you're going to put your bandwidth, you're going to put your energy, your heart, your hard work.
So what is a good amount of hours to spend? Like at least these many hours I have to spend for investing every day. Like what is there a number like that?
No, there's no number like that.
Okay.
See, I would say the target, if you're doing investing by yourself, you should aim to outperform the benchmark that you've selected by at least 10%.
So currently Nifty over the last 30 years have given up to 14% returns. You're saying at least 25% you have to target.
If you're doing it yourself and if you can't make 25, then what's the point?
Yeah, just give it to a mutual fund manager.
But just simply investing in an index fund or in index ETF would have given you 14-15%.
Correct.
A lot of good fund managers have ended up delivering much more than that.
Around
then why take the headache?
Yeah.
Why take the headache of applying your mind, spending time. If you can't, so even when Mr. Buffett, he started his career, he said his goal was to outperform the S&P 500 by a factor of 10% every year. If you're not outperforming by 10%, it's a futile exercise. Because, understand one thing, a retail investor has several powers, I would say superpowers, as compared to an index or a fund manager. So retail investors don't have to worry about concentration.
Right.
You can take large concentrated bets and make a lot of money, which can help you outperform.
Meaning that a mutual fund manager has to at least ensure that each stock will not cross, let's say, 2-3%.
He can't buy more than 10% in a single stock.
More than 10% in a single stock, but a retail investor doesn't have that.
Doesn't have that. Similarly, a retail investor, he doesn't have liquidity constraints. If a fund manager is managing a 20,000 crore portfolio, when he buys, if he has 5% of something, he has to sell 1,000 crores worth of stock, buy or sell 1,000 crores worth of stock.
Okay.
And that causes liquidity impact, etc. There are liquidity constraints. Now, all these constraints retail investors and individual investors don't have. So you can be more nimble. You can be more agile with your portfolio. You can take decisions much quicker. So these are advantages that a retail investor has. And these advantages, if you don't put to use in order to outperform, then there's no point.
Yeah.
I mean, if after if opening your trading account, applying your mind, doing all of these analysis, etc., if you end up with a 4% return compounded, vis-a-vis a 14% for the Nifty, you've done disservice to yourself.
Correct. Yeah. I think most people don't even know what sort of returns they're getting in their investments. They're just looking at an individual stock that they're purchased. Maybe they saw like a 30% growth, and then they brag about it with their friends. And then the friends also are thinking, okay, I need to invest directly in stocks. But nobody knows exactly in an overall year how much has their direct stock portfolio given them.
Absolutely.
So is there something that AI will do to disrupt the wealth management space?
I don't think that will happen.
That will not happen?
I don't think that will happen. I don't think that you can completely... And I don't think generative AI companies will themselves take up the onus of recommending or advising them. Because then they are also venturing into the space of giving advice despite of being not regulated.
Yeah.
I don't think that's going to happen. I think what generative AI companies will do is will help you get data much faster, will help you analyze data much better so that you can make better decisions.
Yeah.
But I don't think generative AI will say put money in an XYZ large cap fund or put money in an XYZ flexi cap fund, because then they are becoming financial advisors stroke distributors.
Yeah.
And they're not regulated to do that. And I don't think regulators are going to ever get comfortable to allow machines entirely give recommendations. So I don't think that's ever going to happen.
All right, guys. I hope this was a very insightful session for you guys. I personally learned a lot of things. Very excited for the future of wealth management and what's going to happen in terms of making our financial lives better. All right, guys. I'll see you in the next one.